Hi, welcome students. I'm Mr. Neil again, your lecturer for Auditing 1. This is our first lesson on the topic of Introduction to Auditing. And this topic will consist a total of 4 short videos. In our first video, we are mainly focusing on explaining why there is a need or why there is a requirement for auditors to audit the financial statements. Before we go into the details, let's quickly tell you that actually in auditing, we say that there are 4 different types of auditors. They are what we usually call the external auditors. And then we have your internal auditors, your government, and then your forensic auditors. So all these different auditors, they perform different roles or different audit function. And in this module, our focus is on the external auditors. So external auditors will actually check on the financial statements to see whether the financial statements present a true and fair view. And you probably heard of common names such as your Deloitte, your KPMG, your Ernst & Young, and then your PwC. So these are audit firms, and these are the what we call the Big 4 auditors. So now we will go on to the lesson details. Okay, in this slide, we will be trying to explain why there is a need for auditing. So if you look at this word here, need, what need here means is, another word for need here is requirement. Why does the law make it mandatory for auditors to audit the financial statements? So it's usually because of the law. So now we'll go on to see why there's such a requirement. Okay, this is the objective of an audit. So the audit is to enable the auditors to express an opinion whether the financial statements are prepared in all material respect in accordance with an identified framework. So if we dissect this whole sentence, a very long sentence, into its key point, you have this word here, opinion. So the audit is to enable auditors to give an opinion. So opinion here, we say that auditors will decide whether or not to give a true and fair audit opinion on the financial statements. So that is then the second big words in this sentence of financial statements. So financial statements, quickly, it consists of what we call the income statement, the balance sheet, and then you have your cash flow statement, your equity, etc. So what they are saying here is the auditors will check on these components of the financial statement to check whether there are any misstatements, which is errors in these financial statements. Okay, the next big word here will be material. Okay, material here means the financial statements contains many different numbers. Some numbers are bigger, some numbers are smaller. And auditors' focus are actually only on significant numbers. They are important to the user of the financial statement. Okay, the last big word here is this word called framework. When the auditors audit the financial statements, they need to follow certain requirements or certain structure to check whether there are errors in the financial statement. So they will see whether the company comply with the accounting standards. So we call that the financial reporting standards. Auditors also audit in accordance with the Singapore standards of auditing. So broadly, these are the 2 main frameworks that the auditors will follow in their audit of the financial statements. Okay, in this slide, it tries to explain to you why the law makes it a requirement or why the law makes it mandatory for auditing by using the principal and agent relationship. So this short chart here means we call this the shareholders, we call them the principals. So these principals means that the shareholders are actually the owners. They own the company. At the other end, there's another group of people who we call the agents. And these agents are the management of the company. So we call them the managers. So they run the company on a day-to-day basis. And we say between these two groups of people, they may result in what we call a conflict of interest. And this conflict of interest arises because the managers may act for their own self-interest to the detrimental of the owners. Okay, the next slide will give you in more greater detail. Also at one end, we have the principal who we say are the absentee owner. Okay, the principals, they are the owners, they own the share in the company. But because they don't run the company on a day-to-day basis, they are what we call an absentee owner, like passive. They don't know as much detail about the company as the agents, who we say are the managers. They are the active managers who runs the company and who know more information about the company. So there is an information gap because the principal has lesser information, whereas the agents who runs the company on a day-to-day basis, they know much more about the company. And when the principal allows the managers to run the company, they actually requires the managers to provide what we call a financial statement, your income statement and your balance sheet, for example, on a regular basis to the shareholders. The financial statements will then account to the shareholders how well the managers are running the business. But can the agents prepare financial statements that contain errors? And can the shareholders put 100% trust in the financial statements that was being prepared? So there was always be this information gap because the shareholders needs to be able to trust the financial statement that was prepared by the agent. This therefore then leads to the requirement for audit. The auditors would need to audit on the financial statements to give credibility to the financial statements, because the auditors is an independent party. He is not related to the managers. By auditing, i.e. by checking on the financial statements that was prepared by the managers, the auditors will be able to give credibility to the financial statement, and thereby the shareholders will be able to trust the financial statements that was prepared by the managers. Okay, now we come to the official definition of auditing. So again, it's a very long sentence. We'll try to dissect them into the key things. Okay, the first important point here is this word called systematic. Okay, systematic here means the auditors must have a plan, or some people call it a strategy, when they audit a company. The next thing here is objectively. Okay, for the auditors' work to have credibility, to be able to be relied upon by the shareholders, we say the auditors must be someone who is independent from the management. Because they are independent, they will not have a conflict interest. They can objectively audit the financial statement. Okay, the next keywords are this: obtaining and evaluating. Okay, this, what it means here is auditors, if they want to give an opinion, they must gather evidence. They will compare the evidence that they have gathered against the financial statements that was prepared to check whether it is consistent. If they are consistent, it means that the financial statements that was prepared is true and fair. On the other hand, if the evidence is inconsistent with the financial statements numbers, it means that there is an error in the financial statement. Okay, the next word here is this, communicating the results. After the auditors finish gathering the evidence, they will have to communicate what they have found to the users of the financial statement. And this communication usually takes the form of what we call an audit report, or in very layman term means the audit opinion. The auditors will prepare a 1 to 2 page report to say whether the financial statements are true and fair or not. Okay, the last big word here will be this, interested users. Okay, the financial statements will be used by many different people, but primarily our auditors' duty to the users are to the shareholders. So this is what we call earlier the principals, or what we call the absentee owners. Because this absentee owner don't run the company, they need the auditors to audit the financial statements to give credibility to the financial statements. Okay, now we have said that these are the 5 main things in the definition of auditing. We'll now give you an example of an audit report. That is the communication of the result to the shareholders. Okay, here is an example of an audit report. The audit report is usually 1 to 2 pages long. It's a standard template because you have to follow the requirements, the standards of auditing. So in here, you see this word here, in our opinion, also in the auditor's opinion. The financial statements are properly drawn up. Also, this word here, properly drawn up, means the auditors is giving a true and fair audit opinion. Okay, in accordance with the provision of the Act and Singapore Financial Reporting Standards. So this is the framework that we say the auditors must audit in accordance with a framework. To give a true and fair view, like what we said earlier, of the state of affairs. So state of affair here means the balance sheet. And of the results, here means the income statement. Then you have other things like your changes in equity, cash flow. The opinion is saying we have audited the financial statements and we are going to give a true and fair audit opinions because the financial statements are being prepared in accordance with the framework of the Singapore Financial Reporting Standards, FRS. Okay, so this is an example of a true and fair audit opinion. So this will belongs to here. So this is what we call true and fair. However, sometimes when the auditors audit the financial statements, they may find that there are errors, and these errors are material errors or significant errors. And if these significant errors are not being corrected by the company, the auditors will have to give what we call a modified report. So modified report in a very layman term means not true and fair. It means the financial statements cannot be relied upon. Okay, with this we have ended the first part of our video. The next part of the video will be going on to understand the concept of audit risk and what are the different components of audit risk. Thank you.